Alright, good morning. My name is Mr. Jones. Today I will be summarizing a few articles that I read that I got from Strategic Finance magazine. All of my articles that I went off of were pretty recently written, so I believe the information is relevant and valid. The first article that I'm going to talk about is Creating Greater Long-Term Sustainable Value by a man named Mr. Mark L. Frigo. His article, I believe, is a great one because it ties into almost all the others. But basically, he starts out by talking about what short-termism, and it is basically the behavior that businesses and accountants focus on, basically showing unrealistic earnings and quarterly reports so that the company looks healthier than it actually is. Living in a paycheck to paycheck kind of mentality. They'll tend to cut discretionary spending to bolster quarterly reports and earnings goals. On the flip side of that is the long-term value creation. It's basically operating in the mindset of future innovation and maintenance of resources and stakeholders. For instance, if you are a logging company and you go in and you just clear cut every single living thing from the forest, then you run out of forest to cut down and you have no future lumber supplies. So that's a really bad business practice. So selectively cutting trees is a more sustainable way of doing things. Basically not sacrificing spending for research and development or employee benefits just to meet revenue goals for the month, is doing those things is basically a short-term way of thinking. And long-term value creation, you need to create, you need to innovate so that you know what the next big thing is going to be and what you're going to have to sell tomorrow. And you're going to have quality employees by retaining quality people and paying them, a fair living wage that they can be proud of. And innovation being the lifeblood of a company, especially today when industries and companies are changing so rapidly, having that investment in innovation is key to being a high-performance company. But keeping in mind that you also have to make a profit right now, so making sure that you are finding that balance between immediate wants and needs of your company and making sure that you have something tomorrow to sell. This article didn't necessarily tie back to any single company or industry, but as a general business philosophy, including accounting, because accountants are often pressured to cook the books, even if it's a legitimate way of doing it and legal and there's nothing wrong with it. It's not necessarily completely honest, just to show that the company is doing good this quarter, even if it is to the detriment of any long-term innovative prospects. It talks about how companies need to adopt long-term value creation, creating tactics if they want to be a high-performance company in the future. We tend to be what I like to call the Twitter society, so we're drive-by mass media culture. We want to take in little bits of information just to give us an idea of what's going on and then make whole big life decisions based on that. That's kind of a bad way to go about your life, so we need to delve into things more in depth so that we can avoid this short-term thinking. Just because something looks like one thing on the surface doesn't necessarily mean that it's actually a good thing. It's definitely not sustainable in resources or to our stakeholders. So the next article that I'm going to talk about is Quality is Everything by Miss Kimberly Howerton Hammond. She basically talks about that quality products are the foundation of any business. With innovation being the lifeblood, quality has got to be the foundation. So whether it be something that you're selling, like an item, a product that you're producing, or a service, be it internal to the company or selling to the public, having a quality product is important. Maintenance being a major factor in quality. As you build, like for instance the general ledger, for as far as an internal product, building that general ledger and financial reports, it is far better to build them a little bit along the way as you go, rather than trying to make up for lost time at the end of the cycle. So it's one of those things that you have to be on top of and keep in check. She also goes on to talk about how hiring quality employees and training and indoctrinating them with that high quality mindset is crucial to long-term value creation of a company, like I talked about earlier. If your employees are just there to check a box and collect a paycheck, then they're not going to be able to keep those quality standards that you are asking of them. She also goes in to talk about how companies often need to cut costs, but there's a way to do that in a quality way as well. So if removing an expense tends to compromise the quality of the product or service that you're selling, then you should probably reconsider cutting that cost. But if it's actually a streamlining aspect to it that's going to actually improve the quality of your product, then that cost definitely needs to go. So the next article that I'm going to talk about for a minute is called Integrating Non-Financials to Create Value, by a couple of people that I'm going to not bother butchering their names. But they're talking about basically non-financial assets are being potentially undervalued in industry and in our reporting methods that we have now. So investments in research and development, human resources, corporate social responsibility programs are actually showing to boost market value added, or MVA, of a company. Things like environmental, social, and governance activities, like maintaining resources such as waterways and forests, contribute to the quality of life and the long-term value creation of an industry. The article also gives an example of a pharmaceutical company that gives a medication free of charge to the WHO, or the World Health Organization, that specifically treats a certain tropical disease. The company that does this does not actually consider it a donation, but more as an investment in goodwill, worldwide. Because as sick people get better, they will also tend to be able to contribute more to the economy, and we'll be able to patronize the business in the future. Investing in the future and building up sustainable industry, by doing that, the future is better guaranteed for companies and its stakeholders. That's again going back to that first article with the long-term value creation and sustainability in industries. Making sure that you're a high-performance company that's going to last. But one of the things that today, because of that drive-by mass media that we have going on in the world today, social media takes on a huge role in getting companies' brand to be known as a socially responsible and charitable company. Then that can be a great investment in time and energy by doing those socially responsible things, like depending on the industry, support the people who are supporting you. On the flip side, a company seen as doing harm can be brought to its knees because of social media and that type of negative marketing. So the last article that I'm going to talk about today is the impact of share-based compensation. It was written by Lester Barenbaum, Bonnie O'Rourke, and Walter Schubert. Basically, the idea of share-based compensation is problematic with our current and established GAAP. So basically, giving or selling at a discount shares of the company causes issues with tax liability because it creates the potential for undeserved tax credits. So essentially, the shares cost the company nothing, so they're basically free for the company to give, but the perceived value of the stock can be deducted from the tax liability, and which can create a windfall for the company, which doesn't necessarily look to be socially responsible like I was talking about before. So those kind of companies can get a little bit of a negative publicity because of that, even though it looks good on the books. In the short term, it doesn't create that long-term value. The author suggests that analysts reclassify net expenditures for stock-based compensation to the operating section of the statement of cash flows, rather than where it's at now, because it's kind of undervalued or it's left out altogether. This tends to provide a better portrayal of compensation expenditures and results in a more accurate assessment of financial performance. So again, that short-term thinking mentality that we've kind of created in our society, and being able to manipulate systems and numbers so that it makes us look better than we actually are, is not a sustainable long-term business model that we should adopt. Anyways, that concludes my presentation. I hope you enjoyed it. Thank you for watching. I do apologize for the background noise and for the poor sound quality. I'm kind of new to this.